Imagine spending 30 years working for the same company. You show up, you do the job. Every month, a portion of your salary goes into your pension. And because you trust the company, because everyone around you is doing the same thing, a significant chunk of that pension is invested in company stock. Your future is tied to the place you built your career. Then one morning, it's gone. The company files for bankruptcy. The stock is worthless. And the pension you spent 3 decades building has been devastated. Not because you did anything wrong, but because everything was in one place. This is not a hypothetical. This happened to thousands of real people, and the company at the center of it was once one of the most valuable businesses on the planet. Welcome back to the Investors Center podcast. I'm Isaiah. Today we're telling the story of Nortel Networks, a company that was worth nearly $400 billion at its peak and was completely gone within a decade. And more importantly, what it teaches us about one of the most dangerous things any investor can do. Before we get into it, if you're looking for the best FCA-regulated platforms in the UK, head to theinvestorcentre.co.uk. All the links are down in the description. Nortel Networks was a Canadian telecommunications company with roots going back to the 1880s. By the late 1990s, it had become one of the most important technology companies in the world. At the height of the dot-com boom in 2000, Nortel's market value peaked at around $398 billion. It made up roughly a third of the entire Toronto Stock Exchange by value. It employed 95,000 people across more than 150 countries. If you were in telecoms, networking, or technology at the turn of the millennium, Nortel was everywhere. Analysts loved it. Pension funds held it. Employees were proud to work there and proud to own the stock. It felt, as these things always do at the peak, like it could only keep going up. Then the dot-com bubble burst. Nortel had borrowed heavily to fund acquisitions during the boom years, betting that the explosive growth in internet infrastructure would continue indefinitely. When the market turned, the debt remained and the revenues collapsed. The share price fell from over $124 to under $1. More than 2/3 of Nortel's workforce was laid off. Billions in value evaporated in months. What followed was years of attempts to restructure, allegations of accounting fraud, and boardroom chaos. Executives were accused of manipulating financial results to trigger bonus payments, even as the company was disintegrating. In 2009, Nortel filed for bankruptcy protection. Its patent portfolio, the last thing of real value it held, was sold off. A company that had once been worth nearly $400 billion was broken up and sold for parts. The share price finished at zero. Here is where the story stops being about a company and starts being about people. Nortel had a defined benefit pension scheme covering tens of thousands of former employees and retirees. When the company went bankrupt, the pension plan was found to be significantly underfunded. In Canada, retirees saw their pension payments cut. People who had worked for decades, planned their retirements around the number they believed was guaranteed, suddenly found themselves with substantially less than they'd been promised. But beyond the pension itself, many current employees had invested heavily in Nortel stock inside their own savings plans. Some had the majority of their retirement savings in a single stock, the stock of the company they worked for. When it went to zero, so did that portion of their future. They lost their jobs and their savings in the same collapse. They weren't reckless people, they were loyal. And loyalty to a single company, it turned out, was an extraordinarily expensive financial strategy. Just a quick one from us. If today's episode has got you thinking about how your money is invested and whether it's spread wisely, we've compared the best UK investing platforms so you don't have to. The links are down in the description, including some current sign-up offers worth looking at. Back into it. The concept at the heart of this story is called concentration risk. It means having too much of your wealth tied to a single asset, one stock, one sector, one company. The old saying about not putting all your eggs in one basket exists for a reason. When one basket hits the floor, everything in it breaks. The problem with concentration risk is that it doesn't always feel like risk when things are going well. When the stock you're heavily invested in is rising, concentration feels like conviction. It feels like you're backing yourself. It only reveals itself as risk when things go wrong, and by then it's too late. The antidote is diversification. Not because diversification maximizes your returns, it doesn't, almost by definition. If you spread your money across hundreds of companies, you won't get the full upside when one of them becomes the next big thing. but you also won't be wiped out when one of them turns out to be the next Nortel. A global index fund holds thousands of companies across dozens of countries. No single failure, however dramatic, can destroy the whole thing. That resilience is the point. And there's a specific version of this lesson that stands out from the Nortel story. Holding large amounts of stock in the company you worked for means that if that company runs into trouble, you could lose your income and your savings in the same collapse. That's not concentration risk, that's double concentration risk. Nortel employees learned that the hard way. Nortel was not a small or obscure company. It was one of the most celebrated businesses of its era, held by some of the most sophisticated investors in the world. It still went to zero, and the people who suffered most were the ones who had put the most trust in a single name. Diversification isn't exciting. It doesn't make for a great story, but it is the closest thing investing has to a free lunch, and Nortel is a reminder of what the alternative can cost. This is not financial advice, it's just information, and we hope it's been useful. Subscribe or follow on whatever platform you're listening on so you don't miss the next episode. I'm Isaiah from the Investors Centre, and we'll see you in the next one.